Chief Investment Officer Gary Reynolds is with us right now, and he's looking closely at the chart, which I assume might be something to do with oil prices, Gary.
It is, Leo, yeah. What a surprise. Is there any other topic to talk about at the moment?
Sure. Well, something around all that there's a lot of talk about, which you could help us understand, is spots and futures.
Oh, okay. So I know a few of our clients have said, what's the difference between a futures price and the spot price? And the answer is the spot price is simply for delivery now. So if I'm selling you a barrel of oil and you say, I want to buy it now, Gary, and I say, fine, the current price is $100. There it is, Leo. Fine, that's great. That's the deal done. You take the oil, I get the $100. I do what I want with the $100. If you say to me, Gary, I want to buy a barrel of oil, but I don't want it until January 2027, then normally I would put the price up on you because you have left me to store the oil, insure the oil, and I don't get that $100 in my pocket. Mm-hmm. So in a normal market, the futures price is higher than the spot price. And that's a thing called contango. And it simply means if you want to buy this from me in the future, I'm charging you more, so that when you take delivery, I make up for the cost of
like
carry.
A storage cost,
absolutely, or all the rest of it. Yeah. Now, at the moment, if it's much cheaper to buy a barrel of oil in 2 or 3 years down the line, when you'll still pay around $70 for it, than it is today, when you're going to pay north of $100 for it. And that is a market that's in a thing called backwardation. And all that means is that it costs more now. And the reason it costs more today than it would in the future is because there's an immediate shortage of the commodity. So because the Strait of Hormuz is closed, there's less oil coming through. 1/5 of the world's oil flows through that strait, and therefore people are short of oil. That's why the price has gone up, the short term, but the long-term price is lower, which also tells you what people generally think is going to happen, and that is that the price is going to go back to a more normal level.
So is this creating a future demand for oil? Are people buying it in more now for the future?
I don't think they're buying it so much for the future, Leo, because that really depends on whether...
taking advantage of the prices, I suppose.
Well,
or is it not really the case? It's just costing more right now. It's not cheaper in the future than it would normally be.
It's not cheaper in the future.
Gotcha.
So if I compared the futures price now and 6 months ago, there's not a lot of difference.
Yeah.
But the spot price is massively different. So obviously the futures price over 1, 2, 3, 4 months has shot up, but it's the spot that's and that's because there's a shortage now. But there's no shortage in the future. We've got more oil than we need. Remember, I've quoted before, the Saudi oil minister of the 1970s, Sheikh Yamani, said the Stone Age didn't end through lack of stone, and the oil age won't end through lack of oil. And it's true, there's always going to be oil. And the US, amazingly, in the last 25 years, have added a Saudi Arabia in terms of oil capacity to global oil availability. So there's not going to be a shortage in the future, and people are still going to divert over towards non-fossil fuels.
So just going back to what you said, how will the oil age end?
It'll end when we can, if we can find a way of making nuclear fusion commercial, so we have this incredible ongoing energy supply. But there's a joke about that. You see, we're 20 years away from achieving nuclear fusion, and in 20 years' time, we'll still be 20 years away from achieving it.
Sure.
But it is ending. So once you've got a big change in the emerging markets, which have become industrialised, but the West is less industrialised now, more service-based. We're becoming more energy efficient in all sorts of ways. Cars are more energy efficient today. Light bulbs are much more energy efficient. And that's meaning that we are consuming less. So, and as the Chinese, because of their incredible technological development, have made solar a lot cheaper, So as we move towards these alternatives, we will be in the end, we won't need oil, we won't need any form of fossil fuel. That's almost inevitable. It's the speed at which we get there is really the issue.
So I'm thinking purely around the value. If oil's got a shelf life, are people benefiting from the higher prices right now before it's not needed anymore?
Yes, this has been. There's perhaps a couple of ways of looking at this. If you're an OPEC member and you're sitting on
OPEC,
organisation of petroleum exporting companies, Saudi and the Gulf states that come together, and the countries that pushed the oil price very high in the 70s and caused mass inflation and huge recessions in the 70s. But let's say if you are Saudi Arabia and your economy is generally reliant on this oil, and even in the 70s, Sheikh Yamani says it won't end through lack of oil. Then oil production has gone up, not down. We produce more oil than we need. They've got to try and balance it, because if they try and get a very high price, customers will buy from somewhere else. If they put the price down too low, they may exhaust their supplies before it's actually needed. It's a balancing act to try and achieve some equilibrium to maximize the sale proceeds of what they've actually got in the ground before nobody wants it. So tricky. I wouldn't want to be tricky being an oil minister in an OPEC country.
Gary, not to trivialise the real impacts of these conflicts, a lot of people, out of sight, out of mind, so to speak, a lot of people are seeing the impacts on shelves at the petrol pumps, for example. When's all this going to end? What impacts is this going to have on inflation? What, in the UK economy, what as a country can we look forward to in, how soon?
So the short-term impact has been pretty hard. Oil's gone from sort of around 70, shot up to just under 120 last week, dropped back a bit when President Trump made some comments about concluding the conflict. To put it in, some people are referring back to the 70s and saying this looks like the 70s again, but oil price started the 70s at below $2 a barrel and entered the 80s at about $38 a barrel. It's a 2,000% increase. We're not in the 70s. For it to be in the 70s, you're going to get the oil price going north of $1,400 a barrel. Then you're really going to see it will be absolutely wonderful at cutting emissions, because we will think seriously about whether we drive anywhere then. But we're not going through that, and that's not going to happen. So you've got the US clearly and Israel with a strategic objective, and that's to degrade Iran's capability of conducting hostilities, and certainly to present them getting a nuclear weapon. And the Americans are not going to want to fight a long war. They won't want another Gulf War. They certainly don't want another Vietnam. They won't want to put American troops into Iran. So what you need to look at is, where is the vested interest here? Who does it benefit to stop this conflict? Well, it benefits the US because they're having to pay for it, and it won't go down well if oil prices are high running into the November midterm elections, which Trump will be mindful of. It certainly benefits China, who imports about 40% of its energy through the Strait of Hormuz, which is closed as a result of this conflict. Incidentally, China gets about 13-14% of its oil from Iran, but it gets the rest from Saudi Arabia. So there's a big interest in China getting its oil back flowing again through the strait. Mm-hmm. It benefits the Iranians, whose economy is in a mess. They need the revenue. So it benefits the other Gulf states. So there's really nobody that benefits from a prolonged war. That being the case, you've got to say the best call is that the parties find a way of resolving this in the next few weeks. Mm-hmm. Bear in mind as well that I think the Americans have planned this quite well, because they obviously did what they did in Venezuela, in kidnapping Maduro and therefore trying to secure Venezuelan oil before they've gone into Iran. And having gone into Iran, once they've achieved their objectives, that would be it. But that means Trump goes to China next month, to Beijing, for a high-level meeting with Xi Jinping with some leverage. And I'm pretty sure around that time they'll try and do a deal where they can bring the Iranians to heel, get some agreement. There'll be pressure being brought to bear there, and I think it will come to an end. And that being the case, I think this has presented itself, notwithstanding the human cost, which is horrendous. Who on their right mind wants to see a school bombed? It's grotesque, but it's been there for a long time, and the world's got thousands of years. We are, unfortunately, as a pretty aggressive species. So, but no one wants to see that. But what it's done, looking at the investment argument, it's made the type of things that we like for the portfolio cheaper. So we enter it, and we, as the markets wobble, we look for the opportunity to buy more of the stuff that we think is good for the long term.
So if you hope and everybody hopes the conflict will end soon as possible, does this mean that you and the investment team, if you're looking for opportunities, does this force you to move quicker?
It can force you to move quicker, because it's almost like all of a sudden things you're interested in buying drop in price, sometimes quite substantially. And you think, well, if I do believe this conflict's coming to an end, and the whole of history tells you conflicts do come to an end, then you take the opportunity and try and go for the asset.
But that doesn't mean bypassing your usual processes.
Never bypass the processes.
That the stocks
never bypass the processes. Those processes are designed to keep you grounded at all times.
So what would you do? Adjust your focus and pour more resource into analysing those stocks in order that you can get them on board while they're at an attractive price?
You run the screening, and because the price has dropped on some of the stocks, they become buyable and more attractive than they were previously. So you look at those, and you look to buy them. Mm-hmm. We bought Asahi recently. That really wasn't necessarily directly a result of the oil conflict, but it gives you an idea that decent stocks sort of rock up and they become good value.
James mentioned that in the recent update. How's it been going since you bought into it?
It's great because I now can drink more beer feeling I'm doing the portfolio a lot of good. And Asahi makes a good beer, and they make Peroni.
Peroni?
I know. And a lot of people don't know that. They think a Peroni is Italian.
Yeah.
It might be an Italian beer, but it's owned by a Japanese company.
Power of a brand.
But Leo, they do make very, very good. Asahi do produce very, very good. Before anybody looks at this thinking that this crisis is driving me towards alcohol, let me say Asahi produces extremely good zero alcohol beers. Asahi Super Dry Zero, awesome. Peroni Zero, awesome. Good beers.
Fantastic. Gary, talking about multiple brands, Jake, in the last client seminar, mentioned Associated British Foods, a brand that's in 90% of households' cupboards.
Yeah, great. Incredible.
There's a massive number of brands. How's that stock been doing?
And that's been doing okay. We actually don't look at it too much in the short term.
Staple stock in the cupboard, is it?
Yeah, well, that's Tetley's tea and the rest of it. So it's some good stuff. And I think that's when we buy these stocks, we review them at least once a year. So they will get screened, and they'll get picked up if their metrics, if the reasons we bought them, if the scores drop. So we have a scoring system for the stocks on the screening, and they have to score above 50 Your 100's the top, 1's the bottom. If the stock drops below 50, we'll have a look at it. Won't necessarily sell it, but we'll have a look at it. We won't generally buy it unless it's above 50 in the first place. But what happens sometimes is that the value you believe was there gets seen by the market and the stock shoots up. And then you have to sell. You might have a stock you really do like, but you have to sell it because it's no longer value, and something else will then be better value. So you move on to the other asset.
So you spot the opportunity, becomes popular, more and more buy into it. That shoots the price up. You sell, and you've made a profit.
Yeah, and then you look for something else, which is good.
Yeah, so you've achieved what you wanted to.
So interestingly, generally with our portfolios, we get higher turnover when they're really performing well, and lower turnover when they're not doing so well. And that's just a feature. So if you see value doing well and the turnover goes up, it's generally a good sign.
Do you ever get emotionally tied to a stock? You know, you say, oh, we like it, but we have to sell it.
No. There are companies I like. There are businesses that I think are very, very good. Funny enough, I've always had a soft spot for Drax. I think because when you go north, driving by those huge chimneys, and I think what they tried to do with moving away from coal to biofuels was very, very, very clever. But no, you have to remember the only people you should have an emotional attachment to is your investors. Mm-hmm. They're the ones that are paying you to do your job. So just because you happen to like a particular company doesn't mean you should get emotionally attached to it. A very, very good one, Royal Mail, that I really liked. I thought they had a fantastic opportunity. In fact, they should have done really well because delivery systems and all the rest of it, they were well placed to benefit from that. And their management was saying, we need to change from being a letters company that delivers parcels to being a parcels company that delivers letters. Then they had a change of management. I think Simon Thompson came in, and we didn't like the management. So how much we liked the business, we canned it. Absolutely right thing to do, by the way. So there are some times when you don't like something about the business, you might make that decision. But just because you do like it doesn't mean you're going to breach your own rules and buy it or keep it.
Crack on with the job. Gary, I want to bring it a little closer to home and try and tie up if we can. All of this conflict. Courtiers funds have had great returns over the last 12 months. We saw that coming into the new year, announcements at the client seminars. What impact has the current conflicts had on those returns? What kind of a dent has it made? Because we know markets, everything's going down apart from prices, which are going up.
Yeah. So we've had a phenomenally good year. It's been a great year for the funds, generally across the board. As the value ethic came back into the markets, we did well. And, as I put that chart up at the December seminar, we'd managed to outperform the Mag 7. Our growth fund had through the 11 months up to the end of November last year, and then we've continued to outperform. We've lost a little bit of the extent of that outperformance through what's happened in Iran. And the reason for that is that the American stocks have done better. And in turn, that's because that America is self-sufficient with energy. It produces about 20 million barrels a day of oil and consumes about 19 million. Incredible achievement. It's done that over 25 years. It's added a massive additional amount of capacity to world oil. So American stocks did better. They went off about 2% in the first week of the crisis, whereas the FTSE went off about 6%. So we lost a little bit relative, but since then it's calmed down a bit. And we take it more as a buying opportunity because we don't think the arguments for tilting away from the big AI driven companies has changed, and it's certainly paid off for us in the last year. And we'll lean more into that. So we treat this as an opportunity to continue with the policy. So if you like, in summary, it took the cherry off the cake and perhaps a spoonful of icing, but not much else. It's still been a good cake for the last year.
Turn it upside down, and what we're actually looking at is not a reduction in the returns, but you're actually looking at the effectiveness of the shock absorption, if you like, as a result of the value and the diversification combined.
Yeah. And the nature, the way we position, perhaps we had less shock absorption than if you'd just been invested in the S&P 500. But that's always going to be the case, Leo. There's always going to be isolated moments when your strategy doesn't work as well as something else. It doesn't matter what happens over a week or a month or 3 months or 6 months. It matters what happens over 3, 5, 10 years. That's what matters, because that's the time horizon for the clients that we're running money for.
Clients being the subject of my last question, Gary, is there anything you'd like to say to our clients before we wrap this up?
Well, wars pass, conflicts pass. I know this is difficult, and modern media means you're bombarded with images and comment, and media thrives on bad news much more than it does on good news. I think the thing to bear in mind is there are a stack of vested interests in bringing this conflict to an end, a stack. And I think for that reason, it is likely to end. Now, I can't say with 100% confidence that would make me a charlatan, because who knows? You can't predict the future with that type of certainty. But on balance, you'd have to say that's where you think things will go. And after that, I think you get back to the basics, which is there's lots of cheap businesses out there. There's lots of low-priced assets, and there's lots of expensive ones around too. And we're less in the expensive ones and more in the better value ones. Value, as you say, Leo. So.
Sure. Gary, thank you for the updates. Just a couple of weeks away from the end of the first quarter of 2026, where I'll then be catching up with the rest of the team, Jake and James, to hear how we've performed and how markets have behaved through this first and fast quarter. Thank you very much.
Thanks, Leo.
If you have any questions, please do speak to your advisor or contact us via the website. Thank you.